Hi, everybody. Thank you for joining us today. My name is Shere, and I'm with Tatanka Funds. Tatanka Funds is a community development financial institution. One of our main focuses and duties is to serve the public, and one of the services we offer is financial literacy. As a part of financial literacy, today our main topic is going to be what is a credit score and explaining a credit score. So I hope you enjoyed the video. Our lovely intern created it, and she did such an awesome job. So stay tuned, and we will start with the pre-test. We'll do the video, and then we'll do a post-test, and hopefully you learn something. Thank you.
Credit scores. What is a credit score? A credit score ranges from 300 to 850 points and is based on credit history, total amount of debt, number of open accounts, payment history, and ability to repay debts on time. So things like late payments will lower your credit score. Why is it important to have a good credit score? Having a good credit score is important because it gives you more opportunities and benefits such as low interest rates on credit cards and loans. So for example, if you wanted a vehicle that was $15,000 and their interest rate is 22%, you end up paying $3,330 extra on top of the loan, totaling to $18,330. Now say the interest rate is dropped to 11% because of your good credit score. Now you only have to pay $1,650 on top of the loan, totaling to $16,650. You also have a better chance for credit card and loan approval. A high credit score shows banks and lenders that you are likely to pay back money loaned to you. Easier approval for rental houses and apartments, better car insurance rates, higher chance at a good paying job. Is no credit worse than bad credit? Yes. No credit means you have no credit history, so there would be no way for creditors to see how likely you are to pay your bills as agreed. Bad credit means you have a credit history of not paying bills as agreed or owe too much money. Both make it hard to get a loan or obtain a credit card, but bad credit is better than having no credit because at least you have some credit to fix than none at all. Although bad credit may be better than no credit, this is no excuse to have bad credit. When to start maintaining your credit. The minimum age you can start building your credit is 18. That's when the choices you make financially start affecting your credit score. It is recommended that young people start building their credit as soon as possible. A few ways to build credit. Get a secure credit card. Use a cosigner to get a small loan at you or the cosigner's bank and pay it back little by little over a long period of time. Become an authorized user. Get credit for the bills you pay. Practice good credit habits. Check your credit scores and reports. Pay your bills on time. Credit agencies, what are they? A credit agency collects information about individuals and business debts. They assign a numerical value, which is called a credit score. This indicates the individual's creditworthiness. The information that is collected determines how much credit is available to that borrower. So say that you wanted a vehicle that is $30,000, but you don't qualify for a loan big enough to cover that total amount, including interest charges, so you can only get a vehicle that is $20,000. How much of the available credit an individual has used, what repayment activity looks like, etc. And there are 3 credit agencies: TransUnion, Equifax, and Experian. Why is it important to maintain your credit score? It is important to maintain your credit score because without good credit, it is almost impossible to get a car, home, or any loans. Good credit benefits and increases your chances at a better lifestyle like a good car or home, and banks will be more likely to approve you for a loan. Good credit scores help in the long run as well. If you have children that are planning on going to college because they could use you as a cosigner for student loans, then you can also help them start their good credit score health. Tips to good credit. Download Credit Karma and monitor your credit. Checking your credit from other agencies can hurt your credit because it will count as inquiry, which lowers your score. However, Credit Karma is free and it does not affect your credit score, even if you check it every day. Pay your bills on time. Don't get into a loan you can't afford to pay. Set up auto pay whenever possible. Today, I'm going to be showing you some tips on how to maintain and keep your credit score good. So the first tip would be to create a Credit Karma account, and I'm going to show you how to create an account. So you would go to the Credit Karma website, and it'll take you to this page, which is step 1. You would enter your email address and create a password, then click next step. And the next step is your information, so like your first name, last name, street address, apartment number if you have one, city, state, zip code, date of birth, and your social security number. So once you've completed all those boxes, then you would click this box right here, which is agreeing to the terms of use and privacy policy. And then you click next step. And the next step is confirming your identity. So this is a series of 3 questions. And the questions might apply to you and they might not. So say one question is asking you if you've had an auto loan around this time, and say you've never had an auto loan. So then there's a choice of none of the above. Click the none of the above if it doesn't apply to you. This is Credit Karma's way of making sure that it's you and not someone trying to be you. So if they do apply to you, then click the right answer, and if they don't, then click none of the above. And if you don't answer them truthfully and it raises suspicion, then you will have to send in a form of ID and other documents, and that will just take longer to create your account, and sometimes your account won't even be created. So make sure you pay attention to the questions. Then once you've answered the questions right, it takes you to see your credit score, and it shows you what type of loans you're paying, if any, and other information. The second tip is pay your bills on time. So set up auto pay, but if you do not have a steady income, auto pay isn't recommended. Know when your bills are due. Have the bill due date saved in a calendar. Don't let your bills pile up, and make sure you're not paying too much. The third tip is don't get into loans you can't afford. The income to debt ratio is the percentage of your monthly income that goes towards paying monthly debts. By using this method, you can calculate what loans you'll be able to pay back. To calculate, add up all monthly payments and divide your monthly income. Now, if you don't know what your monthly income is, it's the amount of money you earned before taxes and other deductions are taken out. So in both examples, the person is working a minimum wage job, and these are the monthly expenses, and this is the monthly income. So we add up all the monthly expenses and divide by the monthly income, and we get 70%. So 70% of this person's income is going to monthly expenses. Now, if they wanted to decrease the bills, they could unplug things when they're not using it, which will lower the light bill, switch to a prepaid phone, which will lower the phone bill, maybe not eat out as much or buy things that are necessary, so like no junk food, stuff like that, to lower the food bill. So once these changes have been made, we added all the monthly expenses and got 710, and then divided by the monthly income, and now we get 49%. So as you can see, it decreased. Taking all these things into consideration will help you in the long run and will help your credit score.